All right, everyone, let's get started. So how's everyone doing? My name is Ken Cerini. I'm the managing partner of Cerini Associates. We're a full service accounting firm that specializes in working with, among other things, nonprofit organizations. We have over 300 nonprofit clients and we're growing. I want to thank the Human Service Council for partnering with us on this presentation. This is a important topic for nonprofits. I know some of the people on the phone on the meeting today or seminar today are for-profit companies. Anybody who's working with government funding is going to find this useful, so don't worry that it says it's a nonprofit update. Again, anyone who's getting government funding is going to find this useful. If you go to the chat, there's a copy of the presentation that we'll be going through today. If anybody wants to print out a copy and have it and move along and take notes as you go along, feel free. I know there's been a lot of presentations regarding the CARES Act and some of the funding sources that are coming from the CARES Act. We want to do this or take it from a little bit of a different perspective. We will be going over some of the principles of some of the major programs of the CARES Act, but really more along the lines of looking at this in terms of how it interplays with your other funding sources. Because from an SBA perspective, there's less of an issue. The bigger issue comes from how this interplays with some of the other funding sources. We're also going to look at this in terms of how the different funding under the CARES Act interplays with each other and how you can maximize the benefit for the organization. If anybody has questions as we go along, please post them to the Q&A. I will try to get to the questions, but I may not be able to do it during the presentation itself. I have a lot of material to cover in 90 minutes. I will stick around after the presentation's over to answer as many questions as I can. So just keep that in mind. The information that's included in this presentation was updated through the 29th of March. I say that because it just seems like information is changing on a regular basis. There's new Q&As that are coming out. So again, just understand that because this is such a dynamic area and information is changing so readily, that some of the stuff that I talk about within this presentation a week from now may not even be applicable anymore. We haven't seen any significant changes between the 29th and today, but I do say that it is the 29th was the last time it was updated. Let's see if we can get this to advance. There we go. So what are we going to be covering today? So again, today we're going to be talking a little bit about the CARES Act funding, how the funds can be used. I know, again, I said I'm not going to spend a lot of time on that. I just want to provide a quick reference because I think it's very, very important as the kind of the fundamental building block that the rest of the presentation is going to be based on. Again, impact of funding streams, how the CARES Act interplays with the other funding streams you may have, whether it be OPWD, SED, or any other government funder that you have out there. Forgiveness, again, I'm not going to go into the whole forgiveness application. I just want to touch on a couple little quick things within forgiveness that you may or may not know about or may have forgotten about that might be useful when you go through the forgiveness process. How to maximize the benefit that's out there. And we have a couple spreadsheets to show you as we go through this in terms of the maximization of the benefit. And we will post those spreadsheets also to the chat. We'll be talking about how to account for the PPP funds that are coming, not PPP, but the CARES Act funding coming in. A little bit about uniform guidance, which is if you receive over $750,000 of federal funding, you have to go through, in essence, a uniform guidance audit with your auditors, which is like an audit on steroids, and then some other stray parting gifts for you. All right, so we're really going to focus today on, I know there's been a lot of different funding that's come through the CARES Act. FEMA, ESSER, there's also been private grants and everything. We're really going to focus on three main funding sources. The PPP loans that have come out round one and round two, the HHS funding for anybody who receives healthcare, Medicaid, Medicare funding, and the employee retention tax credit, which is something that hasn't really gotten a whole lot of attention. And with the new regulations with the second draw PPP that came out, where they now have said that you can get both PPP and ERTC, that has now made the employee retention tax credit a lot more attractive than it was in the past. Understand that if you have other funding sources, if you understand the concept of these three funding sources, you'll understand how the other funding sources will work with each other also. Couple things to keep in mind. The first draw of the PPP, which happened between April 2020 and August 2020, you didn't have to have a drop in revenue for those. The second draw that was just came out in December 2020 has now been extended through May of 2021. You do have to have a drop. It has to be a 25% drop in revenue during any one calendar quarter of 2020. So comparing 2020 to 2019, if you had a 25% drop or more in revenue in any one of the calendar quarters, you would be applicable for the second draw. If you did not go for your first draw because maybe you weren't eligible or you didn't decided not to the first time around, you can now, between now and May, the end of May, you can apply for your first draw. So you don't have to have a 25% drop in your revenue if you've never applied for a first draw to begin with. You can just apply for your first draw. Keep in mind that we're hearing from SBA sources that they may run out of funds within the next couple weeks. So if you're going to be applying, you want to do that pretty quickly before they run out of funds. HHS, as I mentioned, that was for anybody who is receiving Medicaid or Medicare funding. It was 2% or more of patient care revenue. There were 3 rounds of it so far. The first one was just for Medicare, then they added a Medicaid round, and then they opened up a third round. With the additional funding that was made available, I think it was 3 weeks ago when the $3 trillion new bill came out, there's additional funding for healthcare providers. So we expect that there will probably be another round of HHS funding. I've had some conversations with the HHS folks, and they seem to believe that there's going to be a 4th round. And then with the ERTC, there were 2 specific or distinct credits, one for the 2020 payroll and one for 2021, and we'll talk about all of those. So as I said, during this round of the PPP, you can go for your first draw. If you've never had your first draw before, you can go for a second draw if you meet the criteria for the second draw, which again is 300 employees or less. On an aggregated basis, you have to look at it from an aggregate of all of the companies that fall under you. If you're a nonprofit organization, there was a new provision that allowed that if you have not more than 500 employees per physical location, you can do a first draw PPP loan, which is something that you weren't able to do before. This was put into play because organizations like the Red Cross, who maybe has a national presence but has offices throughout each one of the states, the offices were not allowed to apply for this. Now that opens it up if the offices are of less than 500 employees, even though aggregated, the American Red Cross might have more than 500. If any of the offices have less than 500, they can apply, but they can only apply up to 10 million per location and 20 million in aggregate. So they do have to correspond with the other chapters to make sure that there's not going to be an issue. You can actually apply for first draw, second draw, or both if you had enough time and you could spend the money fast enough. So if you applied for the first draw back in December and you choose an 8-week forgiveness period, theoretically, you could go for a second draw now also if you meet the criteria. And as I started to say, the eligibility for the second draw is a 25% drop in revenue in any one calendar quarter of 2020 versus 2019. You have to have 300 employees or less in order to qualify. The total amount of the second draw is capped out at $2 million per organization, 4 million in aggregate. And you have to certify that you used all of the proceeds from the first draw. That doesn't mean you have to have asked for forgiveness. Some of the banks are telling providers that they have to have already asked and received forgiveness in order to get the second draw. That is not the case. You just have to certify that you've used the fund. So just as a refresher, if you remember what the PPP funds were for, they were to cover personnel-related costs, which included any compensation that you paid, salaries, bonuses, combat pay, whatever pay you paid was part of compensation. Health benefits, and this is just the employer portion of health benefits, and this includes health, this includes dental, this includes vision. In December, when the second draw came out, They added life insurance. So any life insurance, group term life insurance and stuff that's paid by the employer is now included. Pension contributions, again, these are the employer contributions into a pension plan. And then state and local taxes, which is basically your New York State unemployment insurance and your MTA tax. So those are the personnel related costs. Personnel related costs have to be a minimum of 60% of the total amount of the funds that you're going to be asking for forgiveness for. So your non-personnel cannot be more than 40%. So keep that in mind. Rent included real estate taxes, including storage facilities, equipment rental, which is copy machines, computers, any other equipment rental. It included utilities, which was heat, light, and power, telephone and internet. It included mortgage interest. So if you own your own building, it would cover the mortgage interest. And then as part of that December 2nd draw, they added some additional costs that are now part of the PPP that you can use towards forgiveness. One of those is your covered operating expenditures, as they call it, which is really just your software or cloud-based solutions that use for payroll processing. So if you use an outside payroll service, sales and billing software, inventory tracking and control software, accounting software, if you have a CRM system for your development office, fundraising software, billing software, medical records software, any of those softwares that you're paying licensing fees for or cloud-based solutions for or anything else, those are all now allowable costs under the PPP. And that's allowable for both the first and the second draw. So even though they only came out in December, they made it retroactive to last year. So if you haven't applied for forgiveness for last year yet, for the first round, you can apply all of these costs against that. Any covered property damage, so any damage that occurred due to the 2020 public disturbances, you can include that now in the PPP forgiveness. Any covered supplier costs, and what this includes is if you entered into a contract for goods that were essential to your operations prior to, and you had a PO prior to the beginning of your covered period, you could then include some of those costs. So let's say, for instance, you entered into a contract for lunches for your students within a classroom for the whole school year, and those are being delivered on a weekly basis or daily basis, and you can't back out of the contract. That would be covered under the PPP. If you entered into maybe a drop shipment of paper every month, any of those types of things where you had a standing PO, open PO, that stuff was being delivered on a regular basis, that could all be included under the PPP. And then covered worker protections. This is going to be your PPE related stuff, anything you needed to do to protect your employees. It could be increased office space. So this really are things that you put in place due to OSHA, CDC, or state and local government requirements. So again, you put up the plastic shields, you set up temperature, you change your ventilation system, anything that's going to be beneficial for your employees. So just keep in mind that the PPP loan was expanded to include some of those things. Just again, as a reminder, how HHS funds are used, and these are your provider relief funds. They're available for COVID-related expenses, not funded by other sources. So again, you can't double dip. You can't charge COVID-related expenses to your PPP and then also to the HHS. It's one or the other. One of the things they did come out with is they said that in order to kind of determine maybe what your COVID-related expenditures are, what you could do is you could calculate your pre-pandemic costs per unit of service and your post-pandemic costs per unit of service, take the delta between the two of them, and that's assumed to be a fair estimate of what your COVID-related expenses are. So to put it in perspective, if your pre-pandemic costs worked out to be $15 a unit, and now it's working out to be $20 a unit, you can take those $5 a unit and consider that your COVID-related expenses. But again, that's as long as those costs are not being covered by another funding source. The way the HHS funds work, the first dollar, so it's kind of a cascading. So the first dollars have to be used for COVID-related expenditures, and then the second dollars are to cover reductions in revenue. So when you look at the reduction in revenue, and this is waffled back and forth, it was first reduction in revenue, then it was changes in net income, then it went back to projected revenue or drops in revenue than it was with and without budget. So they changed this many, many times. The rules as it stands right now is it's looked at on an annual basis, 2020 versus 2019. So you look at your revenue for 2020, you look at your revenue for 2019. If you had a decline in your revenue between 2020 and 2019, you can utilize the HHS funds to fund that decline in revenue. It's not expense related, it's revenue based. If you didn't have a decline, and we have some clients who actually grew during the pandemic, and not because of the benefits of the pandemic, they were just in that growth mode and they were really just getting started in 2019. So they didn't experience a reduction in revenue. But if you can show that you had a reduction from a budget that was approved and ratified prior to March 26, 2020, you can also then compare your 2020 operations to the budget. And if you had a decline against that pre-ratified budget, you can also utilize that as a source for claiming the HHS funding. It is considered a grant or a refundable advance. So again, if you don't necessarily use the funds for either of the two bullets, the COVID-related expenses or the reduction in revenue, you have to refund that money to HHS. Now, originally the funds were set up through December 31st of 2020. They've expanded that, so you have until June 30th of 2021 to utilize the funds. They were supposed to issue by February 15th the regulations and the information on how to show that you utilize the funds and apply for the HHS funding. That hasn't come out yet. We're still waiting. So hopefully that will come out sometime soon. But again, as a refundable advance, if you incur the expenses, you would recognize the revenue as you incur the expenses of COVID-related expenses, or as you incur losses or reductions in revenue, not losses, but reductions in revenue, you'd be able to then recognize the revenue for the HHS grant because of those reductions in revenue. The last piece, the last one of the three major funding sources I want to kind of touch on is the Employee Retention Tax Credit, or the ERTC. Now, there were, like I said, two rounds of this. There was a 2020 round and the 2021 round. The 2021 round is so much more attractive than the 2020 round. So the 2020 round, and it's considered a payroll tax credit. So if you had more than 100 employees, the only way you were eligible to receive anything is if those employees did absolutely nothing for you. So if basically they didn't come to work and you paid them anyway. If you had less than 100 employees, you could get the credit even if those employees were providing services to your organization. So that 100 was a key factor in the 2020 credit. Some of you who may have put some of your employees on furlough, so they weren't getting paid, they were collecting unemployment, but you continued to fund their health insurance. The Employee Retention Tax Credit covers up to $10,000 of wages and employer paid health insurance. So you may, if you have more than 100 employees, and those employees, again, were on furlough, not providing any service, but you continue to pay their health insurance, you may be able to take a credit for 50% of the health insurance you were paying them, up to a maximum of $5,000. So in order for an organization to be eligible for the 2020 round, they had to experience a 50% decrease in revenue, and that was looked at on a quarterly basis. And they continued to qualify until the decrease in revenue was less than 20%. So let me put this in perspective for you. So if in the second quarter of 2020, you experienced a 60% decline in revenue, you would qualify because 60% is greater than 50%. In the third quarter, if you were down in revenue by 35%, you would still qualify. Even though it's less than 50%, you qualified in the second quarter. And because the decline of 35% is more than 20%, you would still get the credit in the third quarter. In the fourth quarter, let's say now you drop down to a decline of 19%. So now, since in the fourth quarter, you're down only 19%, which is less than 20%, you no longer qualify. All right. The other way you can qualify is if you had a full or partial suspension of your operations during any calendar quarter because of a government order limiting commerce, travel, or group meetings due to COVID-19. And it must be more than a nominal impact. So something to look at, and this is an area that some of our clients are looking at, they're going back and looking to see, hey, in that second quarter when the government said, shut down, no operations, you can't open up your building, you can't do anything, 100% employees must stay at home. Well, if you had under 100 employees and your employees were still maybe providing services on a remote basis, you might still qualify for a partial suspension of operations. And you'd have to, again, check to see if there was a more than a nominal impact. And I'll go through that partial suspension in a couple slides. As I said, the 2021 was so much better than the 2020 because the threshold grew from 100 employees up to 500 employees. So now if you have 500 or less employees, you can still provide, those employees could still be providing services to your organization and you'd qualify. And you only don't qualify if you have more than 500 employees. So again, you're barred out of the PPP because you have more than 300 employees. Well, you still may qualify for the ERTC if you had a 20% decline. Again, similar to the 2020 version, it's up to 10,000 of wages and health insurance. The difference is the 10,000 of wages and health insurance under the 2020 was for the entire, you were capped out at 50% of 10,000 of wages and health insurance for the year, or a maximum of 5,000 credit per employee. That was the maximum you can get. The new credit is a 70% credit, so it's up to 70%, and you can look at it on a quarter by quarter basis. So you can actually get as much as 7,000 per quarter if you are down and you meet the eligibility requirements. That was originally, it was supposed to expire by June 30th, but the bill that came out about 3 weeks ago extended it to all 4 quarters of 2021. So what makes you eligible? Remember back in the 2020, you had to have a 50% decline in revenue, and that would stay as long as you stayed above a 20% decline. The 2021 version just says you have to have a 20% decrease, and as long as you have a 20% decrease, you're eligible. It's when you drop below 20%, you're not. And then it goes back again to that same full or partial suspension. So let's talk about that 20% decrease. That 20% decrease, they provided a safe harbor. So the first safe harbor you have is for the first quarter of 2021. You meet the requirements if during the fourth quarter of 2020, and that's calendar quarter, so October 1st to December 31st. If you look at October 1st to December 31st, 2020, compared to October 1st to December 31st, 2019, if you had a 20% decline or more in revenue during that quarter, you qualify for the first quarter of 2021. All right, so that's a safe harbor, because the point was you don't know whether you qualify or not, so you want to make sure that you go in and you have the ability to check beforehand. And then you would then start going the first quarter of 2021, 2022, second quarter of 21. And again, you're looking at the first quarter of 2021, January 1st to March 31st, 2021, compared to the first quarter of 2019. It's not 2020, it's 2019. So remember, 2019 was pre-COVID. So they're comparing the first quarter of 2019 to the first quarter of 2021. And again, if you have a 20% decline in that quarter, you qualify. So again, something you might want to look at if you haven't already looked at. And again, if you get the PPP funding, you can also get ERTC funding. So you can get both. So if you've had a 25% decline in the fourth quarter of 2020, you're eligible for both PPP and ERTC. And we'll talk about, again, how they interplay with each other and how to maximize the benefit under them in a couple slides. I said I'd come back to fully or partially suspended, and here we go. So these are examples that come right out of the CARES Act. So a fully or partially suspended organization would be, so if you're an automaker, auto manufacturer, and you can't get your supplies and parts that you need in order to manufacture because the supplier was not deemed an essential worker and they couldn't supply you with materials. So now you're in a situation where, yeah, you can manufacture, but you don't have any supplies because no one's producing those supplies because they're non-essential. You're fully or partially suspended. A restaurant that closed its doors for indoor dining but opened up carry-out or outdoor dining, they would be fully or partially suspended, as long as they were more than nominally impacted. A physical therapist that can't provide in-person services and maybe can only provide telehealth services. Again, all of these are areas where you'd be fully or partially suspended. If you're an auto repair shop And because your customers aren't driving a lot because of limited travel orders, they're not coming and getting their cars repaired as often. That's not considered a suspension. You're still entitled to be open. A software development company that has allowed teleworking in the past and has comparable operations, they wouldn't have that nominal, they would only have a nominal impact. So there's no suspension there. Or a retail establishment that has to limit the number of people who walk through their door. Again, because they're allowed to be open, it's not considered a suspension. So I bring this up because you should look at your own operations and you should compare what you do from an operational perspective to see. So if you're an early intervention provider and you were center-based, and now you've had to move from a center-based early intervention provider to provide telehealth, and you're seeing more than a nominal change, you'd be considered partially or fully suspended. Same thing with maybe an OPWDD provider who had to change the way they're providing services, maybe for ComHab services or something like that, where it's going to have more than a nominal impact because maybe ComHab was a major portion of their operations. They may be considered fully or partially suspended. I know there's a bunch of questions, and like I said, I have a lot of material. I will get to the questions as quickly as I can. So let's talk a little bit about how the funds, in terms of how the funds can be used. So for the ERTC credit, you apply for that through your payroll company. And what happens is the credit is used to reduce the federal tax deposits that come due on your 941. So one thing to think about, here we are on April 6th. The first quarter just ended. For most of you, the 941s have not yet been filed. So what you want to do is, if you think you're eligible or if you are eligible for the ERTC credit, you want to reach out to your payroll company right away. Each payroll company is handling this differently. Like I know ADP, their cutoff is April 9th. So they're going to be starting to process their 941s on April 9th. So you really have 3 days to get the paperwork in order to apply for the credit before they issue the 941s, because you want to get in there before the 941s are issued so you can get the credit now. Otherwise, you're going to have to wait for the funds to be released. If you're in a situation where you know that you're going to get an extended credit because you know you're going to be down by 20% or more for an extended period of time, let's say you're looking at it and saying, hey, look, I know based on my operations, I'm going to be down for 3, maybe all 4 quarters of the year. You can file a Form 7200, which is basically going to the federal government and saying, hey, we want to get an advance of the tax deposit because we know that the amount of the credit is going to far exceed the amount of the deposit in any quarter. So we're going to be in a situation where we're laying out a lot of money here, but we're not going to be able to get that money back through the tax credit because it's just not big enough, fast enough. So you can file a Form 7200 to get the government to provide you an advance against the payments, the ERTC payments. Keep in mind that there's a lot of documentation that has to come into play here because you have to show, if you're if you're going for the 50% or 20% decline, less of an issue, but clearly if you're going with the partial or fully suspended operations, you want to provide an organizational background or make sure you have an organizational background, including your key revenue and support areas. Document what the order was that gave rise to the shutdown, how the order impacted your organization, when the order was lifted so that you can go back to operating your business. You want to have all of that in case this is ever challenged. Okay, moving on to the next section. So, we've been talking about since the whole PPP came out originally back last year. There's not a big problem with the SBA. From an SBA perspective, Small Business Administration perspective, you're paying salaries, you're incurring rent, you're paying utilities, you're covering these other costs. These are all valid expenses as long as the salaries are under $100,000, blah, 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 blah. All valid expenses, not a problem with the SBA. The problem comes in when you look at the SBA and you get forgiveness, and then how are your other funding sources, your regular funding sources, your government funders, how are they looking at the forgiveness and how does that impact the funding they're providing to you? So I kind of wanted to go over some of the regulations that have come out over the last 6 months. So Medicare, in under their question and answering, under Q&A section, under question 5, they basically, the question was, should SBA loan forgiveness amounts offset expenses on the Medicare cost report? And the answer was no, do not offset SBA loan forgiveness amounts against expenses unless these amounts are attributable to specific claims such as payment for uninsured. The Paycheck Protection Program loan administered by the SBA is a loan designed to provide a direct incentive to small businesses to keep their workers on the payroll. The terms and conditions of the SBA loan forgiveness overseen by the SBA include employee retention criteria, and the funds must be used for eligible expenses. And this was updated on January 7th of 2021. So basically what they're saying is, if you get Medicare funding and you get SBA loan forgiveness, and Medicare, remember, is a fee-based program, so they pay you for the services you provide, they're saying you don't have to treat it as offsetting revenue. It's not going to have a negative impact on your funding, and it's not considered double dipping to get the Medicare funding and the SBA PPP forgiveness. That's an important consideration, because they're actually, and again, it's federal, remember, Medicare is federal, so it's federal Medicare funds and federal PPP, but they're basically saying that they find the PPP and Medicare to be mutually exclusive, they serve different purposes, and it's not going to have a negative impact on your Medicare funding. Extremely important consideration. Then we get to the Consolidated Fiscal Report, which is a cost report that is filed by several agencies. And under the Consolidated Fiscal Report, it says that CARES Act funding is to be included on line 79 of CFR 1. And line 79 is a federal grants line. And that line is considered offsetting revenue for purposes of the rates, reconciliations, and settlements. So what that basically is saying is that if you're going to take the PPP forgiveness and you're going to treat it as offsetting revenue, that will have a negative impact on any cost-based programs. So any cost-based programs that you have in play, that will reduce the expenses under the cost-based programs. And any fee-based programs, that'll have no negative impact on a fee-based program, because the fee-based program doesn't get paid based on costs. So the offsetting revenue will not impact the amount of your fees. So again, I think it's reiterating what the Medicare said, in that a fee-based program is not negatively impacted, but a cost-based program is going to be impacted. Now, if you get funded by like the state education department, they said that if you do have a underspending because of the PPP forgiveness, you'll have to return that underspending this year, but they won't negatively impact you in future rates. Okay, then the Federal Office of Management and Budget came out and said, well, and they only talk about payroll costs, but I think this applies to any cost. They say payroll costs paid with PPP loan or any other federal CARES Act programs must not also be charged to current federal awards, as it would result in the federal government paying for the same expenditure twice. So again, this Federal Office of Management and Budget has to do with cost-based grants. So if I have a cost-based grant or a deficit funded contract where the government says, I'm going to give you $1 million, give me a budget, you provide them with a budget, here's how I'm going to spend the $1 million. And if part of that $1 million, let's say some of the salaries, 100,000 of the salaries you applied for PPP forgiveness for, you didn't really incur that expense. So the federal government says, I'm not going to pay you twice. I'm not going to give it to you under the PPP to cover that salary and then also pay for it under a cost-based or deficit funded contract. So again, I think this is consistent. You have the CFR that's saying cost-based, it gets offset and you don't get to do it twice. That's double dipping. The Office of Management and Budget, who says that it's double dipping. And then you have the fee-based component, which says it's not double dipping and it's not a problem. Now we get to New York State Medicaid. Now, New York State Department of Health has not yet provided any guidance with respect to how the CARES Act interplays with Medicaid funding. We're still waiting for that. I actually thought that once think that once the budget is resolved and they figure out where they are from a budget perspective, we may see some movement on this. But right now, there's no movement. New York State is pretty much open in terms of not providing any answers. But the one thing I do see here, again, is that wherever we've been talking about fee-based, there hasn't been a problem. When we've been talking about cost-based, there has. Medicaid is a fee-based program. My own personal opinion, and this is purely my personal opinion, my own personal opinion is that Medicaid will end up following Medicare. The state tends to follow the federal government. The federal government made the PPP tax-free. The state made the federal government made the PPP tax-free. Federal government said that they were going to fund a portion of the nonprofit unemployment. The state 6 months later followed suit and said, oh, yep, we're going to fund the unemployment also. So I think that New York State will probably get to the point where they will allow the Medicaid funding to be where there won't be a problem or won't be considered double dipping if you got the Medicaid funding and the PPP funding. But again, at this point, we're not sure. I put that out as a caution for everybody. But again, I ultimately think that that's where it's going to fall. Just one thing for anybody who is state education department funded, the See It program, which you would think is tuition based because it still has its roots in cost. So even though they pay you for each unit of service you deliver, if you underspend, you have to use that money in future years for See It services. SED has come out and said that See It services are not impacted by CARES Act funding. So See It services are considered fee-based. So again, no impact on the offsetting revenue. Next, I want to talk about forgiveness. And I said, I'm not going to go deep into forgiveness. I only have 2 slides on this, and forgiveness is much longer than 2 slides. I just want to kind of touch on a couple things here. First of all, don't rush into it. You have 10 months from the end of your covered period to apply for forgiveness. So if you got your funds in the middle of April, so somewhere by the end of September, beginning of October, your covered period would have been over. And then if you count 10 months from there, sometime in July, August is when you actually have to apply for forgiveness. The reason I say don't rush into it, because it seems that good things have come to those who have waited. You already have the cash, so applying for forgiveness isn't going to get you the cash any quicker. The cash is already there. The only thing it may do is it may help you from bond covenants and things like that, but you can always have that conversation with your bank. Think about some of the things that have happened in the last 6 months. ERTC is now allowable if you receive PPP funding. So that wasn't, and in December, they made that allowable. If you've already applied for forgiveness, you may have hurt yourself with respect to being able to go back and apply for ERTC for 2020. We're still waiting on the regulations. As I said, Medicaid hasn't produced regulations yet. So we're still waiting on regulations. Hopefully something will come out soon, but if we wait a little while, maybe we'll get some definitive answers instead of guessing. There have been a tiered approach now to the forgiveness. So for smaller organizations, the forgiveness is much easier. For mid-sized organizations, it's easier than the full-blown form. So, it's gotten easier to ask for forgiveness because the forms have gotten easier. So again, I wouldn't necessarily rush into forgiveness right now. I would start doing some of the analysis and calculations to find out what we're looking at here to make some decisions, but you shouldn't necessarily, or you don't necessarily have to rush into it. One other thing I wanted to make sure that everybody was aware of, and this came out in November of last year when they reissued the forgiveness form the first time. There's a Safe Harbor 1. So if you look at the forgiveness form, there's a little checkbox for Safe Harbor 1. And what it reads is, if you are unable to operate between February 15th, 2020 and the end of the covered period at the same level of business activity as before February 15th, 2020, due to compliance with requirements established or guidance issued between March 1st, 2020 and December 31st, 2020, or with respect to PPP loan made on or after December 27th, 2020, between March 1st, 2020 and the last day of the covered period with respect to such loan, and it was due to Secretary of Health and Human Services, Director of Center of Disease Control or Prevention, or the Occupational Safety and Health Administrator, OSHA, related to the maintenance and standards for sanitation, social distancing, or any other worker or customer safety requirement related to COVID-19. So the reason that that's important is one of the criteria has always been that if you had a reduction in your staffing patterns, so let's say your FTEs prior to February 15th were 100, and your FTEs averaged during your covered period 75, that would mean that you had a 25% decline in your staffing patterns, which means you would have to take a 25% reduction in your PPP forgiveness. Now, there are exceptions to that rule. I'm being very simplistic here, but you'd have to take a 25% reduction. If you fall under this safe harbor from a global basis, and basically, remember, they're saying that that you have to have been able to operate, or you couldn't operate at the same level of business. And there is no formal definition of same level of business here. It's kind of subjective. But I think it kind of goes back similar to the ERTC, where you go back and say, what was I able to open or not able to open? Was there substantial or partial impairment of my business that was more than nominal? I think if you can say that, you can check this box, and then you don't have to worry about the FTE count, and you don't have to worry about if you've had a decline in your FTE count, because you meet the safe harbor, and therefore you don't have to worry about any declines in FTEs. Just make sure that you clearly document what were the changes in the regulations that gave rise to your change in business operations, and the shutdown that they're talking about here, or the OSHA requirements, or the CDC, or HHS requirements. So make sure you document those, when they were invoked, when they were lifted, who invoked them, how do they impact your business, because you want to be able to support the fact that you've checked off this box in case anybody ever comes in for an audit, especially if you have over $2 million worth of funding, where there's a higher likelihood of an audit. The only other thing I wanted to talk about from a forgiveness perspective, so if you filed your forgiveness already, you can't modify the expenses that you reflected on your forgiveness. So what do I mean by this? A lot of organizations, when they went through and they did their forgiveness, they calculated their payroll first. And when they calculated their payroll, remember the original loan was based on 2.5 months, or roughly 10 weeks of payroll. The forgiveness period is 24 weeks. So a lot of organizations found out by putting in the payroll, they had more than enough costs to cover the amount of the loan. So they stopped there. They didn't put in rent. They didn't put in utilities. They didn't put in anything else. They didn't put in health benefits. They took the easy approach, just put the payroll in, stuck it in, filed their PPP forgiveness, and was done. Now the ERTC comes along and says, oh, you can get the ERTC for last year in addition to the PPP. Well, ERTC is only for payroll-related expenses. So if all of your payroll went on the PPP loan application, you can only now charge to the ERTC the amount of any payroll that's in excess of the amount of the PPP forgiveness you received. So if your PPP grant was $1 million and your payroll costs were $1.2 million, $1 million of the $1.2 million is now eaten up by the PPP. That only leaves $200,000 to be used against the ERTC. So just keep in mind that you can't now add other costs to the loan forgiveness and refile the loan forgiveness. Once it's filed and forgiven by the SBA, it's done. As I mentioned before, the HHS forms were supposed to be available by February 15th. They're still not available. Many agencies with multiple funding sources and revenue streams, so if you have a lot of different government funding, the forgiveness piece can get very, very difficult, and we'll talk about that. And again, you also need to understand how the different components of the CARES Act, kind of interplay with your primary funding sources and also with each other. How does PPP, HHS, and ERTC, how they all play well in the same sandbox? So how do we maximize our benefit? And I'm sorry, guys, I know I'm talking really, really fast, but to put it in perspective, I'm about halfway done with our slides so far, and I'm halfway done with my time. So I need to kind of continue at a pretty fast pace. So how do we maximize our benefits? So again, we need to understand how we are funded by our funding sources. Are we cost-based funded, or are we fee-based funded? Because as I showed earlier with the examples with the Medicare and the CFR and the government OMB funding, cost-based, if we're cost-based, we can't double dip. If we're fee-based, it's not really considered double dipping. So the first thing we want to do is understand our funding sources and kind of map out and say, these are our fee-based programs, these are our cost-based programs. Okay, because our fee-based programs, we're going to handle the forgiveness very, very different in our fee-based programs than we are going to in our cost-based programs. So we just have to make sure that we understand how we're funded under both situations. We also then need to consider what each of our funding streams fund. So if we got PPP, ERTC, and HHS funding, we got all three of them, we want to make sure that when we start charging them to the various, or charging costs to the various programs, we're going to charge them in an order that's going to give us the biggest benefit. So PPP is the broadest based. Okay, we can spend 60% on personnel costs, and personnel costs are much broader in definition because it includes health, dental, vision, includes life insurance, includes pension, it includes state and local taxes. None of the other ones consider that. It includes non-personnel costs too, as long as we don't go above that 40% threshold. ERTC is purely salary and health benefits. And as I said before, it's the drop in revenue that you've had overall. So from an ERTC perspective, I'm sorry, let me try that again. ERTC is purely salary and benefits. That's all the ERTC is. So since it's purely salary and benefits, it's not going to have any benefit beyond the salaries that you have in play. So it's purely salary and benefits. So once you apply for the ERTC, it basically becomes $1 because it's covering the salary and benefits. HHS is what I started to say before, covers COVID-related expenses first, and then any drop in revenue that you have. So if you kind of think about it, you want to use the HHS for some of your COVID-related expenses, but then use the rest of it for your drop in revenue because nobody else covers a drop in revenue. ERTC is going to cover certain salaries, and we'll talk about what salaries you should be looking at on the ERTC. And then your PPP is going to be an overlay for everything else. Now, keep in mind, if you are a for-profit business, and I know we have some for-profits on the seminar, if you are a for-profit business, you want to make sure you use your PPP funds because they're tax-free. So if it comes down to using PPP or ERTC, you always want PPP first because you want to get full advantage of the PPP since it's tax-free. You need to consider, like I said, the potential overlap of those funding sources that we just talked about. You also need to consider your administrative costs because when you put your costs into buckets, you have your fee-based programs, you have your cost-based programs, but then you also have your administrative bucket. And your administration is going to get allocated to both your fee and your cost-based programs. So you need to understand how that administrative costs are being allocated to those programs so that you can determine how much of the administrative costs you're going to be asking for forgiveness on too. So again, it gets a little bit complex here because you're looking at layering and step downs and how costs kind of interact with each other. So again, you can, and I kind of mentioned this, you can use the funds to cover losses in cost-based programs. So that's one of the things you want to look at is where are my losses in my cost-based programs? Because if I got a loss in a cost-based program after I allocate my administrative costs, no one's funding that loss. All right, so it's not considered double dipping because no one's funding that loss in my cost-based program. Fee-based programs, since it's not considered double dipping in a fee-based program, remember we're still also waiting on Medicaid guidance, all of the costs in a fee-based program are going to be allowable. So salaries and all of the PPP related expenses, those are all going to be allowable costs in a fee-based program. Revenue declines are useful in your HHS funding only. And if you have an employee who, let's say you decide that you're going to go for ERTC and PPP, so you got both of them, you can layer it. So I can use the first 70% of an employee's salary up to the $10,000 threshold for ERTC, and then anything in excess of that amount I can apply against my PPP. So that same employee could cover both. We just have to make sure that we don't cover the same cost twice. So I can't take 70% of the salary, charge it to ERTC, and then charge 100% of the salary to PPP, because then that clearly is double dipping. All right, so I want to take you through hopefully a little sample spreadsheet here. So hold on a second while I do a new share here. And I think this has been posted to the chat, so you can download a copy of it that's in the chat. So let me take you through this spreadsheet. And this is a kind of a little bit of a rudimentary spreadsheet. It doesn't cover absolutely everything, but I just want you to get the basic concepts here. So I'm going to start with the PPP tab in here. So I want to go through certain assumptions that were made. And I did these assumptions to make it a little bit easier because, again, I want to try to make sure that I don't make this too complex, because you'll get lost in the complexity as opposed to understanding the concepts that I want to bring across here. So we're going to assume, first of all, that the expenses occurred evenly throughout the year, so that, you know, it's a 52-week year. Every week has the exact same expenses. So if my salary is $52,000, it's $1,000 a week. And that's important because, remember, the PPP period covers 24 weeks. So I need that in order to get the 2450 seconds to see how much of it is PPP eligible. We're going to also assume that the PPP loan was received in July of 2020. And I did that so that the whole covered period falls into 1 year, whether it be your calendar year of December 31st or a fiscal year that ends in June 30th. I didn't want to cross over 2 fiscal years because, again, that gets a little complex. We'll talk about it as we go through things, but whatever we do for 1 year, if your grant does cross over a fiscal year, you're going to have to basically split the PPP and look at it in the 2 separate years to make sure that you really understand the impact on each cost report or each funding stream. And we're going to assume that the only staff that made over $100,000, because remember, the PPP limits the compensation up to the first $100,000 of employee compensation. So we're going to assume that the only staff that made over $100,000 were some of your admin staff, your CEOs, COO type people, and that the amount that they made in excess of $100,000 was $256,000. Okay, so those were our 3 assumptions. We're also not going to consider the decline in FTEs, because remember, if we have a decline in FTEs or if we shrunk somebody's salary by more than 25%, there are penalties. We're going to assume that we have no penalties because we didn't shrink anybody's salary by 25% or more, and we did not have a decline in FTEs, or we met that safe harbor I talked about before. So we're not going to get into declines due to FTEs because, again, I want to keep the example fairly simple here. So let's assume that we have various funding sources. So let's assume that we are an organization that has a school for the developmentally disabled that's funded by the SED. We have an OPWD program, and we also have some other deficit funded contracts. We do some fundraising, and we have administrative costs. Okay, so this is our organization. Basically, if we were filling out this organization would have to fill out what's known as a consolidated fiscal report, or CFR, that's a cost report. So I kind of broke the expenses out along those lines. So we have salaries. You can see the salaries within each program. I then broke out the PPP allowable fringes, which would be your health benefits, your pension, your state and local taxes, your life insurance and stuff. I have non-allowable fringes, which would be things like disability, workers' comp, federal unemployment tax if you're a for-profit, FICA tax and stuff like that. I broke out the allowable OTPS and the non-allowable OTPS. The biggest chunk of the non-allowable OTPS for most organizations are going to be outside contractors. Could have transportation in the OPWD world. And then I broke out property and equipment. So I broke out everything between what's allowable and what's non-allowable for PPP purposes. Then I went and I allocated the $1.3 million of administrative costs to all of the various programs using a allowable allocation methodology, which looks at expenditures, and it's called the ratio value method, and that's the method that's used for the consolidated fiscal report. But most cost reports and most organizations do use some level of expenditure allocation for allocating their administrative costs. So I allocated the administrative costs across, and I came up with my totals of $12,196,000 broken out by each program. Remember, the first column is SED tuition based, second column is fee based, third column is IDEA grants, which are spend down grants or deficit funded grants. Fourth column is my OPWD fee-based. My fifth column is my cost-based other grants. Then I have my fundraising. I then compared that to my revenue, and I can see overall the organization made a profit of $520,000. It lost money in its tuition-based program. It made money in both of its fee-based programs. It lost money in its deficit-funded contracts, and it did well on its fundraising, bringing in $194,000 of profit on fundraising. I then calculated how much of the administrative costs are allowable. And I calculated the allowable administrative costs by taking all of the administrative costs, backing out the $256,000 of administrative costs, and then multiplying it by the administrative percentage to see how much of the administrative costs go to each category. And then here I just worked off the PPP allowable costs. So this is really just looking at the PPP allowable administration. Because remember, in administration, I have some non-allowable costs too. So I said, all right, so based on this, what can I get PPP forgiveness for? So in my tuition-based program, my SED tuition-based program, I lost $69,000. So as long as I have salaries during my forgiveness period of $69,000 or more, or PPP allowable costs during my forgiveness period of $69,000 or more, I get all of that. So I marked off, I get $69,000 of the profit there. I'm sorry, of the loss. On my fee-based program, any salaries that fall during my forgiveness period, I get credit for. So I took 24/50 seconds of all of my allowable direct costs. That's my salaries, my OTPS, and my property and equipment. And then I took 24/50 seconds of my allowable admin costs, because again, we're assuming that it's earned evenly over the year. So that entitles me then to $114,000 of forgiveness on my SED fee-based program. Again, it doesn't matter that I made a profit of $105,000 in those programs. That's irrelevant. I can get on top of the profit, I can still claim 114 because that's what my costs were during my forgiveness period. On my IDEA grant, again, it's a deficit funded contract. And since that deficit funded contract broke even, I get nothing. I don't have a loss that I can apply against, and it's deficit funded, so I can't ask for any money. On my OPWD program, again, I go through that same calculation I did in my fee-based SED program. I got $1,676,000 of forgiveness. And again, that's on top of the $315 profit I already made. On my other deficit funded contracts, again, those are cost-based. I'm limited only to my loss of $25,000. And my fundraising, again, same as my fee-based programs. I can get my I can get a profit on my fundraising for all of the costs that I laid out. I can get forgiveness on. So if you calculate it all out, you come up to $1,975,000 worth of eligible costs. We're assuming that the PPP loan was $1,895,000, so I'd be eligible to get 100% of my PPP loan. Again, I want to stress that most of your OPWD funding under your fee-based program is Medicaid funding. This is assuming that Medicaid funding is going to be okay and that we're not going to have a problem with it. So again, under this example, we would be in a situation that we would get full forgiveness of our PPP loan. So let's talk about now something very similar. We're going to go to the next chart here. And what we're going to look at now is, well, how does this work if I also have HHS and ERTC funding? So again, our PPP loan is the same $1,895,000 because our example is going to be the exact same example. The only thing we've added now is that we received $246,000 worth of HHS funding, and we received ERTC funding of $482,000 from January to June of 2021. All right. So our revenue, we're saying between 2021 and 2019 declined by 27%. So because we had a decline in revenue by 27%, we're eligible, it's more than 20%, so we're eligible for the ERTC funding. Now we have 118 employees. So theoretically, at 118 employees, I can ask for $7,000, up to $7,000 per employee. In this case, we chose not to ask for all of the ERTC funding because it wasn't going to be to our advantage to ask for all the ERTC funding. And I'll show that as we go through the presentation. Okay. So our example is exactly the same. Our columns are the same. Our numbers are all the same. So we come all the way down here and up to line 46, everything is exactly the same as it was on the first slide first Excel spreadsheet that we're looking at. So now the only thing I've done here now is I've added the extra funding. So for HHS, remember, HHS funding is only for healthcare related. So your SED programs are all tuition based. Those are not healthcare related. The only program that we have here that was healthcare related was the OPWD program. So we can take any COVID related expenses that are in that OPWD program and we can offset those against the HHS funding. We only had $7,234 worth of COVID related expenses. So therefore, we take that first, because remember, COVID related expenses go first. Then the balance of the HHS is revenue. So we had a decline in revenue, and I showed that the decline in revenue up top was more than enough to cover the $238,000. So we get the full $238,000. Then we get into the ERTC. So when we were applying for the ERTC credit, we said, well, why would we take the ERTC credit for any cost-based program? Because if I take the ERTC credit for a cost-based program, that's going to lower my costs within the cost-based program. I'm just going to have to give that money back to my funding source, and it could actually have a negative impact on my operations or my rates, depending on how my funding goes. It could result in lower funding in a future year. It could result in lower reimbursement going forward. So I really don't want to take any ERTC funding in a cost-based program. So as you can see, there's no ERTC funding in any of my cost-based programs because I don't want ERTC funding in my cost-based programs. It doesn't do me any good. I am going to take, though, my ERTC funding in my tuition-based programs. Now, I may not take ERTC funding for all of my tuition-based programs. The best way to do it is again, think about how it layers with PPP. So PPP will cover all of the salaries of fee-based programs, right? So it's going to cover all the salaries within a fee-based program. So if I got and I was talking to a client this morning who got their PPP draw 2 on March 6th. So their funding came in on March 6th for their PPP loan. So for January and February and their funding came in March 7th. So their funding through March 6th. For that 2 months and 6 days, nobody was funding their payroll, right? There was no PPP going against their payroll because the PPP didn't kick in until March 7th. HHS doesn't cover necessarily the payroll and per se. So why not go for the ERTC funding for the period from January 1st to March 6th, since no one else is covering that funding anyway? Take your ERTC funding and apply for ERTC for that stub period of time, then run through your 24 weeks and then start asking for ERTC funding again after the 24 weeks if you still qualify. If you're in a situation where, let's say you look at this and you say, well, in the first quarter of the year, I'm going to be eligible for ERTC, but that's the only quarter I'm going to be eligible for because my revenue wasn't going to be down by more than 20% starting in the second quarter. Maybe I want to apply for ERTC funding for all my fee-based in the first quarter, take it all for all of my fee-based programs for the first quarter, because I can then use my PPP from the second quarter forward. So again, you have to look at how these things interplay to see how you can maximize the benefit of them. So in this case, we have $28,000 worth of ERTC in our SED fee-based program, $426 in our OPWD program, and $28,000 in our fundraising program. So what does that leave us? So while I can take the $69,062 against my PPP loss in my fee-based program, I can take 86,000 of PPP against my fee-based program in my SED world, because my total allowable expenses for PPP are 114. I use 28,000 of that against my ERTC. So all that's left is 86. Again, my IDEA grants, I can take 1,243,000 against of the PPP against my OPWD, because I used 426 of ERTC and I used 7,234 of HHS COVID related. I can take 25,217 against the loss on my deficit funded contracts. And again, similar on my fundraising, I used 28,000 of the ERTC, that leaves 62. So overall now I got my HHS of 7,234. I got my HHS revenue of 238. I got my ERTC of 482. I'm using 1,485,000 of my PPP forgiveness. That gives me total forgiveness of 2,213,000. I had total eligible CARES Act funding of 2,622,000, which means that I underspent my PPP by $409,000. And that $409,000, I have to make a decision what to do with. I can either repay it and go through the loan, or I can apply it against one of my cost-based programs. If I'm a for-profit business and I have an SED who said they're going to hold me harmless, I would apply the full 409 against my SED program, generate an underspending in SED, have SED take that money back, and then I get the tax credit for the fact that I lost money, because this would have been tax-free money. So keep that in mind. If you're a for-profit business, you want to use up all your PPP. If you're a for-profit business, you may not have taken all 482 of your ERTC. You may have reduced the amount of ERTC you're taking because you don't want to end up with any amount of PPP unused. So hopefully that makes sense to everyone. And I'm going to go back to the presentation. So just a couple things that we kind of talked about during that. I'll go through them pretty quickly. If you have a June 30th year end, by waiting to apply for the second draw, you can push more of that into fiscal 2022. Think about it. You already got your you already got your first draw. Your first draw covered part of fiscal 20 for most of you and part of fiscal 21. If you push off your second draw, some of that will cover fiscal 21, which you already got some of that on the first draw. And now that'll push you into fiscal 2022. If you think about the way offsetting revenue works, especially when you're dealing with the agencies that settle through the consolidated fiscal report or something similar, the offsetting revenue doesn't look at it from a time, at it for a year perspective. So it says, what were my costs for the year? What was my offsetting revenue? And it's assumed it's for the whole year. And then you come down with your net revenue. So you can basically use, if you push some of the PPP into fiscal 2022, and that covers, let's say, July and August, you can basically use the funding that you get in July and August in terms of your salaries and related PPP related costs. You can use that to offset losses during the later part of the year. You also may want to, I said, consider claiming the ERTC prior to the second draw, as I mentioned before in my example with the March 7th, and again after the covered period is over. You also may want to think about if you're in a if you're a totally fee-based program, you may want to limit your PPP to 8 weeks, and then up to the ERTC all around it. This way you might be able to get a higher benefit out of the ERTC. If you are cost-based or have fee and a large cost-based, you definitely don't want to do the 8 weeks. You want to do the 24 weeks because you want to spread that out as long as you possibly can. Some grants, we talked about the IDEA grant, some grants can be delayed and used in future years. So the way the IDEA grant works is if I don't use the funds this year, I can roll it forward into future years. So if that's the case, why not take all of your costs off your grant, let that roll over into future years, pull those costs into your cost-based program, generate a bigger loss in the cost-based program, and use more of the PPP if you have unused PPP. So again, you want to strategize. If you know you're going to have some unused PPP, another thing you may want to do is you may want to go to some of your cost-based funding sources and ask them if they would extend the length of your contract. So instead of it being a 1-year contract, maybe it's 1 year and 3 months. Or ask them if they will allow you to rearrange the costs that are being spent on the contract to try to get more costs that are not covered under PPP. So will they cover some of the costs that PPP doesn't cover? So instead of just paying for the salaries, maybe they'll pay for more employee benefits that aren't covered by PPP. Maybe they'll cover some of the equipment related costs and stuff like that aren't covered by PPP. So take a look, communicate with your funding streams and see if you can maybe rearrange costs that are being charged to be able to allow you to take a bigger advantage of the PPP funds or the ERTC funds. Again, when you consider use as a fund, look to maximize the non-salary expenses within PPP. Remember, you can go up to 40%. If you think about it, ERTC is all salary based. It's salary and health benefits, and that's it. So if you're going to interplay the two of them, PPP and ERTC, you want to have as much salary available for the ERTC as possible so that you want to then charge as much of the PPP to other areas. If you've gotten a second draw loan, take some of the spreadsheets that we went over, try to start figuring out where you think your costs are going to lay out, how much of the PPP and ERTC you're going to be using, and then decide what other things you may want to do. It might make sense to give your staff a bonus or give your staff a raise. It might make sense to incur some additional costs within your programs that are PPP fundable, so that all of those things now will be covered during that covered period and will allow you to then charge more of the PPP and be able to offset more of it. And as I mentioned before, consider taking the ERTC funding for only certain staff members, because again, it doesn't do you any real benefit within the cost-based programs. I think most of these strategies we talked about pulling costs off the grant, have a conversation with your cost-based funders, spend more on needed expenditures. We talked about that. We talked about not charging ERTC to deficit funded contracts. Again, ERTC are used first, so you want to make sure that you only pull down what you need under the ERTC. We talked about for-profit businesses. PPP and ERTC are not subject to uniform guidance. We'll talk about that in a few minutes. HHS is subject to uniform guidance, so kind of keep that in mind. If you get the HHS funding, it's going to be subject to uniform guidance. And then we talked about the budgeting on the second draw. So just a couple things to keep in mind. So when you're looking at CARES Act funding or you're looking at your normal funding stream, is it better to take one or the other? Well, I think the answer there is it depends, and you got to kind of evaluate. If you think about it, if there's going to be no long-term penalty for drawing down the funds and you just have to give the money back to your funding stream, but it's not going to impact you on a go-forward basis, your PPP has a 1% interest rate retroactive to the date the loan that was taken out. Most of your funding streams are not going to charge you an interest rate to recoup the funds. So you would save that 1% interest rate if you didn't need the money. PPP gives you either 2 years or 5 years. If you know you're not going to be spending all of your PPP funds, you may want to go back to your bank and see if you can extend the terms from a 2-year loan, if you're an early draw on the first draw, to a 5-year loan. Some of the banks we've heard have been willing to give a 5-year loan instead of a 2-year loan. That would give you a longer payout period. It'd be 1% interest, but that's a very cheap interest loan, and it would give you time to pay it back. Funding streams may or may not give you an extended period of time to pay back. For for-profit businesses, taxability is a key thing. You want that tax-free break. You got to look at allocation of overhead costs. If you apply the PPP against your normal funding streams, that could have a negative impact on maybe an indirect cost screen or something like that. So you got to kind of keep that in mind. How does it impact your rates and your reimbursement and everything else? So that all has to be evaluated when you're going through that. And then again, just make sure that you're doing good documentation. You want to track how the funds are being used in case you're audited. Again, clearly, if you have over $2 million worth of funding, there's a higher likelihood of auditing. You want to make sure that you're able to support in case a funding stream comes in and not the SBA, that you're not double dipping. So you want to show, okay, I used the money here, I didn't use it here, I didn't take it for any cost-based programs, I only took it for the fee-based programs, and just kind of lay it out. Make sure that you know which employers are being coded to which area, so that when you're getting the forgiveness, you're asking for it for the right employees, and we're getting the ERTC, you're asking for the right employees, and you can substantiate where the employees were allocated. So go through, create an analysis similar to kind of what I had. Again, my examples were somewhat simplistic. We have a client who has already gone through this, and it was multiple spreadsheets to kind of make sure they understood how everything tied together and everything was linked. So you want to make sure that's all together. That's also helpful if a bank asks, or the SBA or an auditor asks, or anything else. You can ensure that you've got support, and you can also ensure that you're maximizing your forgiveness. Okay, I got 13 minutes left of the main presentation. I know there are questions out there, and like I said, I will get to them as quickly as possible. Just want to talk a little bit about some of the accounting regulations. So according to the U.S. Department of Housing and Human Services, HHS, the general distribution payments are subject to certain legal terms as the HHS funding. The funds are to reimburse the recipient only for health-related costs and lost revenue. The funds must be used only to prevent, prepare for, or respond to COVID-19. If you go to the Q&A, it's a broad definition. Anybody who pretty much does healthcare-related services is going to meet that broad definition. If you don't comply with the terms and conditions, they can recoup the funds. And if you don't use the funds, you have to reimburse them. So based on the fact that this is, for all practical purposes, a grant of funds, under accounting regulations, the HHS funds, whether you're a nonprofit or for-profit, they'd be handled under ASC 958-605, which is the revenue recognition. They'd be handled as a refundable advance or a conditional grant. So as long as you've met the criteria, the funds were used for their intended purpose, then you would recognize the revenue as you incur the expense or realize a decrease in revenue. So that's something that you should be then recognizing. For most of you would have recognized your HHS funding during 2020, because most of you experienced large declines in revenue in 2020. PPP, you can account for the PPP in two ways. You can either account for it under ASU Topic 470, which treats it as a loan. So you treat it as a loan throughout. And then when the loan receives SBA approval for forgiveness, you would release the loan, and it would be recorded in revenue as a gain on extinguishment of debt. If you're using ASU Topic 470, you would also then any interest, that was forgiven would also go under extinguishment of debt. And you would also calculate any financing costs. So like if you paid someone to help you get the loan, or you paid an accountant to do some of the calculations and stuff, that would all get capitalized at the time that the loan was received. And then all of those costs would also get wiped out as part of that debt forgiveness. The other way you can record the PPP is you can record it the same way you do the HSS, as a refundable advance under ASC 958-605, which basically says that as you incur the expenses that are allowable expenses and that are forgivable, you would then recognize the revenue in conjunction with the incurring of those expenses. Either way, you have to disclose within your financial statement what your policy is. ERTC. ERTC is really a tax credit. It's considered a tax credit, but for accounting purposes, you're going to treat it the same way as you are the HHS funds under 958-605. It's treated as a government grant or support, and you would recognize the revenue when you incur the payroll. So for most people, most organizations, unless you go for you apply for the 7,200, where you're looking for prepayment of the ERTC funds, most people, when they get the funds, they're going to be booking on their books a receivable when they incur the salaries. When the credit is released back to them, they'll reduce the receivable, but they'll have a flowing receivable. If they do get that advance from the federal government, they'd put it on the books as deferred revenue, and then they would recognize the revenue as they incur the underlying salaries. And again, that's basically the same way as the HHS funds are being handled. For IRS purposes, when you're doing your tax return, IRS considers the ERTC as an offset to salary expense. So when the tax returns are being filed, they would be offset. I want to speak a little bit about uniform guidance. And again, uniform guidance is if you receive federal funding in excess of $750,000. I laid out here some of the CARES Act funding that's come in and whether that CARES Act funding is or is not subject to uniform guidance. So we've talked about ERTC is not, PPP is not, HHS is. Any of you who received an EIDL grants are subject to, or EIDL loans, I should say, are subject to uniform guidance. So again, if you got over $750,000 worth of federal funding from all federal sources, or incurred, I'm sorry, I say federal funding, incurred expenditures, allowable expenditures, or in the case of like a loan, an EIDL loan or something that would go towards that count, then you're subject to uniform guidance. So you have to kind of keep in mind that this is not just for CARES Act funding. So if you happen to get any other federal funding, let's say you have a CACFP grant, which is a food program grant. So if you have that food program grant, that's also federal funding, and you have to take that into consideration. I know we've been talking a little bit about IDEA funding throughout, just so anybody who does get IDEA funding, even though IDEA funding is federally originated, anybody who gets that funding, any of the programs that get that funding are considered not subrecipients, they're considered vendors. So the IDEA funding does not count towards the federal funding. So again, you have to take into consideration all sources of federal funding. As I mentioned, ERTC is not subject to uniform guidance. It's a refundable tax credit. HHS funding is part of the uniform guidance. One of the things I suggest is if you are going to cross over that $750,000 threshold, and I've got some clients who received more than $750,000 alone in HHS funding, what you should do is there's a compliance supplement that is put out by the Office of Management and Budget. You should go download that compliance supplement for your HHS funding and take a look at the compliance supplement and really familiarize yourself with what your requirements are, because there's a lot of compliance issues that come into play, and you want to make sure that you're properly following those compliance issues. So again, go back in, take a look at that. I did link here, I provided a link to the AICPA single audit requirements with respect to CARES Act funding. And in here, they have links to the Q&As. In here, they also have links to some of the compliance supplements. So this is a really, really good link to go and take a look at if you think you might be subject to uniform guidance because of this. They're also updating it on a regular basis. So it's really good up-to-date information. So really, uniform guidance will require, and it's not just nonprofits, it's for-profits too, to undergo a more extensive audit of their control environment and compliance requirements attributable to their major programs. So again, something that keep in mind, most of you have, a lot of you may have never gone through uniform guidance, and this might be your first foray into the uniform guidance world. It is a more in-depth audit. Make sure whatever accounting firm you're working with has experience in working with and doing uniform guidance audits. As I mentioned, make sure you look at your compliance supplements and familiarize yourself with your compliance supplements, and make sure that you document how the funds were used and other compliance criteria in accordance with the compliance supplement. A couple other quick things I wanted to kind of bring up. I mentioned before the PRF portal. It's open for registration, but it's not accepting submissions for the HHS reporting yet. That was supposed to be out by February 15th. There's no time frame at this moment when the portal will be accepting such submissions. If you have registered on the portal already, they will notify you when the reporting submission is when you're able to do it. If you haven't registered yet for the PRF portal, and that's if you got your HHS funding, please go and register so that you get notification. In addition, the audit protocols for the programs receiving in excess of $2 million were supposed to be out in mid-February. They have not yet been published. As soon as those audit protocols come out, we will be doing a training session for anybody who gets over $2 million worth of funding. So you definitely want to go and take a look at that once they're out. That's just me. If anybody has any questions, I will go into the Q&A right now. This is the last one. I just wanted to make sure that everybody is aware that this information as of March 29th is provided as, this is our interpretation of the CARES Act, so we have to go through this disclaimer. Obviously there might be additional information that you might need to look at. I went through this pretty quickly and I gave some examples, but your example might be uniquely different. All right, so let's see what we got by way of questions. Can you address the eligibility of ministers' compensation for inclusion in PPP, ERTC, FFCRA credits? Ministers are going to have W-2 earnings, which again, the W-2 earnings will be eligible for the PPP and the ERTC. Ministers also get housing credits. So when you have your housing credits, that housing credit is, and I'll have to look into it. And if you want to send me an email on this, Lisa, I'll get you a definitive answer on how the housing credit is handled on that. And sorry, I don't want to give you a wrong answer. My gut tells me that you would be able to cover it under PPP, but if you send me an email, a direct email, I will get you an answer on that. Next question. Under the PPP first or second, would cost for financing solar or the building count? If you have mortgage interest is an allowable cost under the PPP. So any mortgage-related interest would be an allowable cost under PPP. Did you say that the HHS funds need to be utilized by 6/30/21? That is what I said. Right now, as far as I know, there is no extension on the HHS funds. Those all have to be either used to cover COVID-related expenses, which is a very, very broad definition, or decreases in revenue. Remember, those decreases in revenue would be real decreases in revenue between 20 and 19, or decreases from a budget that was approved before March 26th. For the ERTC 2020 payroll tax credit, this is comparing Q1 2020 to Q1 2019, and so on. So for the ERTC 2020 payroll tax credit, you are comparing the quarter in 2020 to the same quarter of 2019. And that's what you're looking for, that 50% decline. When you get to the 2021 ERTC credit, you're comparing the fourth quarter of 2020 to the fourth quarter of 2019 for your safe harbor. And if you're looking at it within 2021, you're looking at the first quarter of 2021 versus the first quarter of 2019. And yes, you can still apply for the ERTC for 2020. You're going to have to reach out to your payroll company. They're going to have to file a 941X form. And that 941X form, it might take you 6 to 9 months to get the money back from the IRS, but you are still eligible to apply for the ERTC. And if you got the PPP, make sure that you properly consider both the ERTC and PPP when you're applying for forgiveness. For the purpose of calculating employees, if the threshold of FTE or strictly a head count. So if you're calculating employees for purposes of the forgiveness calculation, it's an FTE calculation. And again, that FTE is based on a 40-hour work week. And there are two ways you can do the FTE calculation. It could be based on the simplified method, where anybody who worked under 40 hours is a 0.5, anybody who worked over 40 hours is a 1.0, or it could be the more complex, where you would take, if somebody worked 35 hours, it'd be 35 over 40. But that is the calculation for the Forgiveness is an FTE calculation. And again, that's where that safe harbor 1 comes into play. Would you consider OPWD, IRA, and ICF rates fee-based or cost-based? If you asked me that in the past, I would have said both, because they were going back and they were doing rebasing every several years. At this point, the methodology is a little bit up in the air in terms of what they're going to be doing from a methodology perspective. I would consider them fee-based at this point. I know you advise the difference between cost and fee-based, but if we receive Medicaid reimbursement for services for a behavioral health clinic, does it count as double dipping to use PPP for those expenses? If you have a behavioral health clinic and you're paid on a fee-for-service basis, okay, that's a fee-based program. If you remember, I said that DOH at this point, Department of Health, has not yet given any guidance as to whether they are going to have an issue with Medicaid funding and whether it would be considered double dipping. Medicare has come out and said it's not considered double dipping. We believe that Medicaid will follow suit and say the same thing, but that's just my internal belief. Until the DOH issues any guidance, we don't know for sure. Again, you have time before you have to issue the PPP forgiveness. So I would wait a little while longer and see if any guidance comes out of DOH. I know there are certain coalitions that are still trying to get answers to that. Can you explain what you mean by OPWDD fee-based? Would that be monies collected for community classes by an organization? So OPWDD fee-based would be any program that you get a fee for service as opposed to a program that you're being reimbursed based upon costs. So your family support contracts would typically be cost-based. Most of the other OPWD funding is fee-based at this point. Again, you know, the methodology isn't fully out. I know there's some questions as to what that methodology is going to look like. So just keep that in mind. I have a home office and I own my house. Under PPP, can I deduct the percentage of mortgage interest that corresponds to the percentage of mortgage that I apply to home office? I wouldn't. Keep in mind that you're limited anyway as a sole proprietor to $20,833 worth of forgiveness. So you probably or shouldn't need the home office. But I would not do the home office piece. Our bank portal is calculating a PPP loan larger than we need based upon our 941s. Do we take the full loan and immediately repay, or adjust our average payroll to match need rather than 941? So if the bank is calculating a larger amount than your 941s, first of all, that it kind of doesn't make sense because it should be based on 2.5 months of payroll. And remember, your forgiveness period is 24 weeks. So your forgiveness period is going to be a longer period than the 2.5 months, and it covers more than just payroll. But remember, you're only entitled to 2.5 months of revenue, and again, 2.5 months, I'm sorry, payroll. And remember, when you do that calculation of payroll isn't just coming off your 941s, because it includes payroll, it includes health insurance, dental insurance, vision, pension, state and local taxes. So it's more than just the salary that you're paying to your staff. So it should be more than the 941s, but you have to go through and do the calculation to make sure it's being done correctly. We have received PPP loan in the amount of $2 million. We filed for forgiveness, rent of $800,000, which is 40%, wages of $3 million. According to the form instructions, we need to report all wages paid in order to document and calculate FTE and wage reduction. We were forgiven the entire loan of $2 million. How much of the forgiving amount should we apply to wages and how much to rent? In your case, it doesn't matter because you've had enough to cover everything. The SBA is looking at this from a global perspective, and when you record it as revenue, you're going to record it as revenue for the full $2 million is going to go through as forgiveness of debt. If you're concerned about how it interplays with your other funding streams, I think with the fact that you've got $3,800,000, I think you can calculate it within your funding streams. And as long as you work within the context of the 800 and the 3 million that you've placed on the forgiveness form, you're fine. To calculate actual payroll FTE based on IRS FTE calculations, would we use 30 hours or 40 hours per week as the standard work hours? To calculate the payroll FTE, it says on IRS FTE calculations. I'm not exactly sure what it's meant by IRS FTE calculations. For purpose of the forgiveness is based on the 40 hours per week is what the forgiveness is based on. The ERTC is based on 30 hours per week. So hopefully that answered the question. Does the 20,833 forgiveness on PPP include both draws? So the 20,833 is for the first draw, and then you can do another 20,833 for the second draw on an individual. And I'm assuming that, Renee, you're a sole proprietor. So if that's the case, you've got 20,833 for each draw. If you have any employees, you can also then cover the employees. Okay. And then I think there were some questions in the chat, and it's a little harder for me to find the questions in the chat, so I apologize. In applying for PPP forgiveness, easy form, what type of backup needs to be attached for payroll? You don't have to really attach anything if you're using the easy form. The easy form is basically just that. It's a really simple form. If you're talking about the intermediate form, it's really what the bank is going to ask for. So you have to kind of discuss with your bank what they're going to need, because their bank does the initial check, and then after the bank does the initial check, then the SBA will do the follow-up check. I'm looking for a grant or grants to move from one business industry to another. Okay, I'm not going to go there because that's not the purpose of the discussion. Page 4 of the presentation, can you please clarify the second bullet point regarding the 10 million and 20 million? Our bank capped us at 10 million. We're expecting a little more than 20 million. The maximum that any organization can get is 10 million. The 20 million would be on an aggregated basis. So if there are multiple organizations, there is a possibility of getting more than 20. So if the bank capped you at $10 million and there were multiple organizations and the aggregated amount would have gotten to more than 10, you might want to go back to your bank and have a conversation with them. For ERTC, is the reduction in earned income or total income? For ERTC, is the reduction in earned income or total income? The credit is on gross wages, if that's what the question is asking. There will be a recording of this that we push out to everybody, and we will also be pushing out the slides. Can you share the second spreadsheet? Okay, the second spreadsheet has been shared. Can an EIDL, an EIDL loan, be forgiven? The EIDL loan, from a forgiveness perspective, there was only the initial $10,000 EIDL loan that could be forgiven. The rest of the EIDL loan has to be paid back as a loan. The second draw is also a 24-week period, so it's not just first draw. And then our nonprofit 457B deferred compensation payments eligible under PPP. They are considered non-qualified plans, 457 plans, so they would not be eligible as far as I understand. I think I've answered all of the questions. I want to thank everybody for sticking in there with me. I know I went a little over. I want to once again thank HSC for supporting us on this and being our partners in this presentation. And I want to thank everybody for participating. If anybody has any questions, again, my contact information is there. Feel free to reach out and ask any questions you have. More than happy to help with anything anybody has. So thank you, everybody. It was great being here with you today. I wish you could have done this in person, but maybe next time. Take care.